Hey everybody, welcome back to 5 Minute Financial Markets. Is this the end of the bear market rally? It certainly appears so, but let's dive into it. There's a lot to talk about today. So if we look at the daily S&P chart, last week we had this big green candle on Wednesday when the Fed announced their quarter point rate hike. Jerome Powell came out with the softest, most dovish tone he's had since this whole inflation crisis started. And he's really been getting hammered, at least from the people that I listen to, for what seemed to be an irresponsible message and tone that he was sending to the markets. We've already had this big run up over the last several weeks. There's a palpable feel of FOMO in the market. You're starting to see dumb money retail traders come piling back in, bidding up stocks like Bed Bath & Beyond and Carvana that have no business getting bid up right now. In the opinion of most people, it's the job of the Fed to temper this mania in markets, especially when we have severe underlying economic weakness. And a lot of people expected Jerome Powell to come out last Wednesday and have a more hawkish tone that would bring some reality back to these markets. That is not what he did. The market blasted up even higher. Thursday, we gapped up out of this channel that we've been inside, what appears to be the blow-off top that will end this rally. And then Friday, cold water got thrown on before the bell with a jobs report that came out way hotter than expected. Again, we're in this sort of bizarro time where good news is sometimes bad news is sometimes good news. Normally a good jobs report is great because it means the economy is healthy. This jobs report was insanely hot. 500,000 new jobs added versus an expectation of about 160,000. Again, normally a good thing, but it shows just how hot this economy is and how big the inflationary pressures are that still exist even after all the rate hikes. Completely contrary to what Jerome Powell was trying to tell us on Wednesday. So Friday was a real kangaroo day. We gapped down lower, raced back up to close the gap, and then sold off really hard into the end of the day, bringing us back into this channel and, at least to my eye, confirming that this rally has ended. Today we had another up and down day with this indecision, what's known as a doji candle, long tail at the top and bottom and a very short body in the middle. So is there anything else telling us that this rally is over? Yes, there is. Let's look at the US dollar. The dollar's been steadily grinding lower for the last several months in this channel. Had a little false breakout here, but other than that, has stayed right in this channel since early November. The last 3 days, it's up almost 3%, which for the dollar is a really big move. Completely broken out of this channel and reversed this downward trend. When the dollar gets stronger, that's bad news for assets that are priced in dollars, such as equities, precious metals, commodities, crypto. Separate but related, you can see the 10-year yield and the 2-year yield here that have also spiked over the last couple days. 25 basis points on the 10-year, 35 basis points on the 2-year. That is also a very bearish indicator for stocks, especially tech stocks and high valuation stocks, because so much of their value is based on future earnings, which are discounted by current yields. When those yields go up, the valuations go way down. But here's a really troubling sign for the market, and that is where the Fed funds futures contracts are pricing in future rate hikes. Now, before Friday, the futures market had priced in one additional rate hike in March, and then had the Fed holding rates steady all the way through November, where they priced in a rate cut back to 450 to 475, where rates currently are, and then another rate hike in December back down to 425 to 450. Now you can see that has shifted. We're now forecast to have an additional rate hike in May, pushing the peak rate up to 5 to 5.25%, holding all the way till December, and then cutting back down to 475 to 500 by December. That means a higher peak Fed funds rate holding for longer. That is very bad news if you want to see this market going higher. Meanwhile, as I mentioned earlier, we've got this irrational exuberance in the market. The fear and greed index is up into extreme greed levels. Like I said, penny stocks, meme stocks getting bid up like crazy. Irrational buying, which is usually the hallmark of the end of a rally. So looking on the calendar, there are no less than 7 Fed speakers this week, starting with the big dog, Jerome Powell, tomorrow morning, 9:40 Pacific. I'm hopeful that Powell got smacked around enough over the weekend that now he knows he needs to come out and introduce some reality to these markets and let people know that the job is not done on inflation, the Fed is not done hiking, and stop buying bankrupt companies and worthless stocks. Now, typically when I trade, I'm buying and selling options in a really short to medium term horizon, like same day out to maybe a week or two. And I still have some puts out for the next week or so because I do expect to pull back in the near term. But as I said last time, and as I've said many times, the great quote by John Maynard Keynes, markets can remain irrational longer than you can remain solvent. And with that in mind, I realize that this market could run further and this FOMO could carry this market even higher. So I'm going out several months into the future, buying some put spreads. A put spread is where you buy a put at one strike, sell another put at a lower strike. That way you're not getting chewed up by the time decay because you've got both a long and a short position. And that gives you a longer time horizon to get down to those target prices. That's all I've got for today. Stay safe out there. Try to keep emotion out of it. Keep your wits about you. Practice good risk management. And if you enjoy this content, please hit like and subscribe. See you next time.